Friday. Welcome to a practical options workshop. This is something I've been planning on doing for a while. Practical options is a course that I built for anybody that is interested, wanting to learn how to trade some options, and hopefully accelerate the learning curve where it doesn't have to be as complicated as the, you know, difficult language, vocabulary, terms. What's risk graph look like? How do you find your options? What is an option? All the stuff that's kind of boring. You see a lot of people's eyes just gloss over when you're talking about a call option is the right, not the obligation, and the put option is the obligation, blah, blah, whatever. All those stuff that you just see in every textbook and every definition of investopedia.com, it doesn't help you trade options. So, what I want to do today is have a workshop for everybody and have it on my YouTube channel. So, it's just there forever and talk about some very simple, straightforward ways to trade the markets up, down, and sideways and generate some income. We don't have to own anything. We can trade indexes. We can trade individual stocks. We can trade currencies. We can trade commodities. We can trade gold and silver. We can trade whatever we want. So, pretty nice stuff. So, we'll get the room filled up here momentarily. I will say that I'm going live. I do have some trades that I'll be watching in the background. I did close out some iron butterflies for my double up service. I do want to just kind of, again, like I did yesterday, like entertain myself. I was up $100 in profit. I took the profit. Today I was up about 50 to 60 bucks net profit, and I'm watching to see how the rest of this day plays out. I have a pin price at 68.50. I have a pin price at 6,800. I have a pin price at 6,900. So basically, I'm covered anywhere between 60, let's see here, 67.70 all the way up to 69.20 with some overlapping profit taking zones. I'll know a lot more in the next 2 hours when we get to close to see if any of these are spot on. Here are the levels that I chose intentionally. This positive negative gamma pivot point is 68.45. If this is where price is going to stick for the day, that 68.50 is worth about $1,780. I'll do the math and see where it settles. If we come all the way back up towards the highs today, this is a high around 68.79. I have a 6,900 by 68.70. So if we get up to this level, that's about $1,000 profit trap. If we go higher, that gets even better. This one pays up to $2,500. If we go down to some fresh lows, I have a 6,800, also, I believe 25 or 30 wide. That 6,800 is 30 wide. So if I'm down to 6,800 or 6,810, that's $1,000 profit trap. So there's risk on the trade. There's risk overall. But at the end of the day, it's like we have a high, we have a low. We basically came back and gap filled. The market's still remaining in negative gamma, but hasn't done a ton of price action damage for the day. We might just stay sticky around this positive negative gamma pivot point, which is between 68.45, 68.50. So we might actually have a really nice winner on the day if anybody's still managing that trade. The call option, put option volume sentiment is kind of hanging out, stuck between the bulls and bears, which means there's probably not a lot of additional direction. So this would give me, let's say we close right here at 36 or 37. If I had a 68.50 minus 12.50, let's see here. So 17.75 is my max profit minus $12. I'd make 575 bucks. On one trade, I'm risking 90 cents. And the other trade, I'm risking $500. I'd still walk away positive. If I'm somewhere close, if I'm like spot on towards that 45 or 50, this trade gets a lot bigger into profit. I can make up to 1,700 bucks. And my other risk is 90 cents and $5. So 590 and $1,000 winner, I could walk away with like 500 bucks profit on the day. So we will see. The day isn't done. There's still another couple hours left, and we'll continue to monitor. I was going to push on Zoom there, Donna. However, the Zoom somehow didn't have like an authentication. And so rather than going to Zoom and running only through Zoom, because what I want to do is start my Zoom session first and then go into YouTube, it wouldn't let me authenticate the YouTube stream. So I'm just doing the YouTube stream, and I will take this recording and I will post it inside my Telegram. So today's session, I will record. It's going to be archived on my YouTube channel, and I'll take this video and also post it inside of my Telegram for everybody. Cool. All right. Am I going 2 hours today? Possibly. It would be, practical options, good education. Let's just see where the time takes us. Obviously, it's pretty easier for me to fill 60 minutes, probably 90 minutes especially when it's talking strategy and education. And if we're going to take this into the close, we might be live here for a couple of hours, which I think it's a great workshop to have with the education. It's timeless, it's evergreen. You can come back and check it out whenever you want to. And we've got some trades to discuss in the end of the day. So overall, I'll start by saying, whoever's coming in to watch this live, welcome. Let me post this in Telegram really quickly. So here, let's go practical options. Free strategy session. All traders welcome. Okay, so put that out on Telegram. Make sure that's the right channel. It is. Here we go. Daily profit play. I did 2 contracts on the trade that I took. I took off a 50% winner. The other one that I'm watching for the remainder of the day, I'm going to try to let this one go down to like 20 cents. So I still have 1 contract left in the trade. It's trading for 29. I've got a debit at 20. I'm going to try to get this closed out by the end of the day for 80 cents out of the $100. It's looking pretty good for full profit, to be honest. Let me take a look at this level. So 67.90 would be, it's a 7 delta, 67.90. Yeah, we'd have to have a pretty big move to the downside by end of day. So there's about a 91% chance of profit that stays the same. We stay somewhere in the middle. The call side is way up here. The put side is down here. I think we're going to be okay. I'm still going to take the safe trade and get out for 80 cents on the dollar for the max credit. So if that hits here, that'll be 1 winner at $50, 1 winner $80, and net pretty good on the day. And then also have that net winner on the iron flies that I did this morning as well. Zoom is already on the 3rd hole. I'm not sure what that means. Thanks for the bonus trade in SPX we closed yesterday. Yep. Sean, is that your butterfly spread? Is that the bonus trade we did on the butterfly? $1.35, closed it out for 30 cents. That was a nice little winner. That trade took 24 hours. I'm totally happy with that trade, to be honest. So, yep, good stuff. Don, I'm not sure what that Zoom request is, but I'm not running this on Zoom right now. It wouldn't authenticate, wouldn't let me run on Zoom and YouTube. So I'm just going to go to YouTube. When I run this on Restream, it streams at the same time on YouTube, on Facebook, on Twitter, on LinkedIn, and I think Twitch as well. It's like 5 or 6 platforms that I stream on. Larry says, I did the 6850 fly 10 wide XP. Okay. You did a 10 wide fly for $1. That's good, man. That's great, actually, for $1. Yeah, I did. My debit was a little bit higher than I wanted it to be. Max risk was, I'm trying to think. I've got it here in my notes. So max risk of 715, max risk of 5, max risk of 90 cents. I was definitely taking some risks today. But I was spaced out big enough between like 130, 150 point area that late in the day, I'm like, I think I can turn this into net profit. And I did. Yeah, I didn't make a ton of money here. I made like $50. But that also lets me focus on practical options, run this workshop, and not have to sit here and micromanage my trades. Because it is 3 trades to manage all at once. And if I'm, taking profit on one, I've got to quickly close the others out to make sure that like the net profit is still achievable. But the nice part is that 6850 is looking like a stickier spot. So if we're at 40 to 50 today, I originally did that trade for a 25 wide. So if we're close to 45 or close to 55 today, that was 25. That's a $1,500 winner. That's a $2,000 winner. Well, I take that back. No, it's probably close to like $1,000 winner. Sorry, because I pulled in 1775. So if we're between 45 and 55, that's going to be about $1,000 winner, which is not bad. Okay. $1.40 and 30-cent debit. Very nice. Yeah, that was a great trade. Yep, that was a nice little winner on the broken wing. Happy with that. And Larry, yep, you see the email I sent you earlier today as well. So you've got that referral code if you're interested in getting the live gamma stuff. That package is awesome. I do use this stuff every single day. It gives me a high degree of confidence where I can kind of see price finding levels for the day. It's rare that we break too low. It's rare we break too high. A lot of these levels get super sticky in real time, and those double up type strategies can work very very well. If you like the butterfly spreads, you like the iron flies, they can be great setups for some pretty safe income through the day. Yep, very good. Okie dokie. So let's do this. I'll keep an eye on this stuff through the day. We'll see how this thing is going to close. I did post some videos today also for my pinch point scanner. So Practical Options is running now. My Project Options Edge, I did a full video review in all positions. So every position we have open on Pinch Point Scanner. We do have two trades that are potentially going to need some repair. We'll see. But I have a ratio spread on Pfizer. I have some naked puts on Chipotle. There's still time in the trade. They're out to December. But Chipotle may take some assignment on all of my positions. It's trading around like 31 and change right now. My break even would be about $38.80. I don't plan on losing the trade. I would take the shares, invest the capital, and repair it for anywhere between $100 to $500 and avoid a loss. But it's going to take some capital to do that. We'll see what happens if that does occur. I said this in the video. If that does occur in Chipotle, I will do a video specifically on what I'm doing. We'll kind of update this as a campaign trade, and I don't plan on losing either one of these. If I take shares of Pfizer, I think Pfizer is near some pretty significant lows. I could see Pfizer easily ripping back into the 30s going into 2026. Chipotle is a little bit more in question because it was a great stock for a lot of years, and it seems like right now this fast casual trend has been to the downside. Like the demographics that they highlighted this week's earnings. I don't know if it was last week or this week, but earnings on Chipotle, their demographic of like the 20 to 30-year-old, 20 to 35-year-old, that demographic has been changing and not as frequent to the stores. And obviously, when you go get a burrito bowl and throw on some guac for $20, it's a little more expensive than just grabbing a sub from Subway, or heaven forbid, getting the crazy unhealthy food at every other fast food restaurant. So that's way cheaper. So it's not fun. It's like I think it's difficult when fast casual food is $15 to $20. It's no cheaper than, you can go to a restaurant and eat for the same amount. If you go to like your Applebee's and TGI Fridays and Chili's, those entrees are $9 to $15. Granted, you pay for service on that, but you go tip the staff $1 at Chipotle and you spend 15 to $20 on a burrito bowl or a salad or nachos or queso or whatever they charge extra. It's like it's not cheap, and that's clearly been dragging the prices a little bit lower. We'll see, but like I said, because of options, you can take the shares. I'm happy to take the shares. I think the smart thing would be let's protect the downside in case something worse happens to it, just to be on the safe side and just give us some time. Because if the price falls lower, I don't see Chipotle's going out of business. I think it is a solid chain. They might restructure their prices. They might close some stores. I have no idea, but ultimately, I think the stock price still has some value to it. Okay. And Gordon says, do you have training videos on how to use credit spreads? Gordon, you're in the right place, my friend, because what do you think we're talking about today? Practical Options is exactly that. Okay, so check it out. I do have a couple of videos if you want to take not just this workshop, but also some other stuff. I have my YouTube channel. You can go to youtube.com/Chris Pulver and search for, let's see here, search for strategy session. And there is a trading 101 strategy session. Check it out. A lot of this is the shortcut version of what you just asked. So doing credit spreads, doing debit spreads, long calls, long puts. That is also so if you see this thumbnail, trading 101 strategy session, check out these videos. So trading 101 strategy session. Let me see if I can do this exact search, trading 101 strategy session. See if that thumbnail pops up multiple times. So there is one that's an hour 26. Here's one for an hour 13. And there might be one more, but certainly check out those two. This one is fast track to profitable trading. Again, a lot of this is options. So this says up, down, sideways. I do talk about the markets using basic call options, bullish spreads, and bearish spreads. Same thing here, up, down, sideways. They're two different segments. But again, I think it's just helpful to explain it, put it into the market so it makes it applicable, and then understanding that if you take a trade, what does it mean? Where does price have to be for you to be profitable? Does it have to be above a certain price, below a certain price? Where's your risk? What's your reward? The nice thing about option trading is I equate it to trading, or I'm sorry, I equate it to playing chess. If you move your pawn or move your knight or move your bishop, you're also, you're scanning the board to see what your opponent might be doing. You're trying to think of 1, 2 steps ahead, and so all you trade with options is price and time. Okay. So I want to simplify. That's what this is for. I want to simplify, the mystique and the confusion and the intimidation factor that comes with trading options. I've heard this for the last year. I mean, I joined Prosperity Pub last year, and I run a lot of services. There's a lot of live trades. Every trade I take is live. Every trade I do is live money, and we've got a pretty good track record on everything. We have waterfall income winning 94, 95% of the trades. We have project options edge winning 94% of the trades. Daily profit play, about 90% of the trades. Pinch point scanners, 85 plus percent of the trades. My newsbreakers is like 75%. The only low strategy as far as win rate is a one that I'm doing, like where my reward to risk is like 5 to 1 or 10 to 1. So I win about 58, 59% of my trades, but our winners are huge. So point is, they're all options based. And, this is what I was told. Chris, you got to teach people how to just buy calls and buy puts. And I'm sorry, but that to me is the most basic way to trade options. And I get that it works for people because it's really simple. But I don't like the fact that this is what can happen. Watch. Give me a feedback. Give me feedback in the chat here. If you were to do this, if I can illustrate this, let me see if I can get a drawing tool up. Sometimes my drawing tool disappears on me for some reason. Not sure where it went. All right, let me just do this. I'll go to the charts. So if I were to say, okay, we're going to do a call option on Amazon. Total example. If I do a call option, this is the price of Amazon. Okay. If I buy a call option right now and price is trading at whatever the price is, this is live price of Amazon in the circle. So this is live price. I buy a call option. Well, the premium or the price that the broker asked me to pay for that is going to put my break even up here. Okay. So I pay a debit. This is my break even. Now, what is crazy about this is if Amazon goes up over time, by the time I get to this level, I get the direction right and I don't make any money. That drives me crazy as a long option trader. If I buy a call option and I see that the market makers and the sophisticated algos that have these levels and guardrails on every single trade, if price doesn't move enough and move fast enough, I'm going to lose even though I got the direction right. And that is where most traders lose money trading options, is they get priced into something that is basically going to be the destination, not necessarily the ability for price to exceed it. If price exceeds it, then you can make money, but you have to cover the cost of your trade. And that to me is more difficult. So, what I like to do, and this is my personal preference, is I like to teach people how to understand a basic spread strategy. Because if I trade Amazon here, and all I need Amazon to do is if I buy a call at current price and I sell a call just above that, let's say that I do a $2.50 spread. So I will buy, this will be a +1, and I'll go into more details here, but this will be a +1 for a buy. This is a -1 for a sell. So I buy the at the money strike. This is just an example, and I sell one strike higher. Let's say that it's a 250 spread, and the broker says, okay, you're going to pay $1.25 for the trade. Okay. So I pay $1.25. Now on that trade, if price goes up over time, all I have to do is cover the cost of my trade. I only need Amazon to go up $1.25. Okay. Versus if I paid $5, $6, $7, $8, $10 for a long call, I need price to go up a lot higher to cover a call option versus just covering a spread. So if I want to risk the same amount of money, maybe I go 5, 6, 7 contracts on this one, I can risk the same amount as I would on a call option, but the line in the sand for me is way lower. I don't need to cover that $10 break even. I need to cover a $1.25 break even. Okay. So that is to me a huge advantage of just understanding, look, I'm going to cap my upside. My SPX just got filled. So I got another winner here. I'm going to close that out. So daily profit play, I'll update. Daily profit play. Okay, DPP update. Today, I had 2 contracts running. One closed at 50 cents debit. One closed at 20 cents debit. Very nice way to win for the day. So a plus 50. So $1.30 total profit. Okay, so good stuff there. Does that make sense? So it just makes my line in the sand way, way closer. All right. Now I want to go into more details here. Let's walk through some examples. I mean, feel free to give me some tickers, or we can just focus on like one example. If we just focus on, hey, I'm gonna trade the SPY. I'm gonna trade the SPY. I'll trade Nvidia. I'll trade Apple. I'll trade Amazon. Like I don't care what you want to trade. Okay, it all works the same. The prices are going to be slightly different. When you choose individual stocks, usually the spread options are a little bit cheaper than if you trade the indexes. Indexes are a little bit more expensive because there's an inherent bias to go up on the Qs and up on the SPY. So typically, what you're paying is about 2/3 of the width. All I'm saying is we'll do some examples. We'll walk through a lot of those today. Okay, so let me get some comments here. I was losing money on straight calls and puts, but now I'm winning on at least some spreads. That's good, says Linda. Let's see here. Dean says, I have a bear call spread on XSP, bull put spread on natural gas. Okay, good. Spreads and flies are the only way to go. At least 90% has been doing this last year. Okay, how about Meta? I mean, Meta's fine. I just think Meta can fall a little bit lower. I hope that it does. We're down to 650. I put a trade in yesterday as a bonus trade. If we come down to 610, 615, I'm looking for Meta to leak a little bit lower if we can get filled on a nice little debit spread. Here is an example. Okay, here's an example. So I did this as a bonus trade. I'm happy to give this trade out. We did a 610 by 610 by 615. I show that right here. Meta. 610 by 615 for a 240 debit. It didn't fill. It's obviously got to fall a little bit lower for me to get this fill, but I'll use this as a live example. So I'm doing a trade here. I'm doing a Meta. I think I'm going out to the end of the year, December 19th. So 12/19 expiration. I'm buying the 610 call and I am selling the 615 call. I am requesting from the broker to fill me at $2.40 debit. So that's a max risk of $2.40. That is a max credit of $5, which means my max profit would be $2.60. Okay, so how do I make money and where is my risk? So this is a good way to kind of start this off with a good example. Why did I choose the 610, 615 zone? Because there's a nice little gap fill back in here. If we gap down to like 590, we come back to hit this demand zone. That's around 620. Fill this gap with price action around 610. So I'm going 610 by 615. That would be a pretty aggressive retreat on Netflix or on Meta if we get there. And I'm looking to see if like by the end of the year, this thing can have some type of trough and try to attempt to fill the earnings gap that yeah, I mean, again, I could be wrong, but the worst case scenario is if I lose on this trade, if I get filled and I lose, I'm losing 240 bucks. Okay, so let's go into more details on how do I make money. So number one, if Meta continues to fall to around 610, this trade should fill. So then I'll be into the trade. Okay, and then if filled, I need Meta to rally greater than 615 by expiration for my full profit, which should be a $5 credit minus the 240 debit equals $2.60 profit on the trade. So if I'm right on the trade, I make 260 and the most I was risking was 240, I can return 108% return on risk if I'm right on that trade. Okay, now I can also manage partial profit. Okay, I can also manage partial profit if Meta rallies up and my trade shows a higher probability of profit, the credit will increase. Okay, so for example, is let's say we get filled on the trade and all of a sudden it rips back up to like 630, 635, something like that. Example, price rallies to 630. My 240 debit might show $3 credit, might show $3.30 credit, might show $3.50 credit. Okay, that's not a max profit of $5, but I'm at least showing some profit on the trade. Does that make sense? So I'm right here reading this out. So it might show partial profit. Now, if I want to, let's say that I take the trade for 240 and I want to go ahead and take some partial profit. Well, if I have a $3.40 credit and I take the $100 winner, what's that return? If I grab $100 profit on the trade and I don't want to hold the trade all the way to December, I make 100 out of a risk of 240. I'm up 41.6% return on that risk. That's not bad. I like to take a lot of my option trades. If you want to increase your probability of profit, take a 30, 40, or 50% profit target. And that way you don't have to wait to expiration. You don't need price to do much. You just need price to cooperate. But you can get out of those trades way earlier than holding it all the way to expiration. So, 40 and 50 is kind of my sweet spot. I'll take 30 when my stuff's expensive. If I get like if this is a $10 wide spread, then I'd probably go for like a 30 to 40% winner. But if it's 250 wide or 5 wide, I'll go after that 40 to 50%. Okay. Let's see here. AJ, could you explain how to close a broken butterfly? I bought at 125, closed at 135, lost money. Why? And what trades you take? I mean, that's just understanding the debits and credits. So you say broken butterfly, which means that should have been taken for a credit. So if you pull, so you gotta, yeah, I need some more details. Let's put a pin in that right now. Type it in the chat. I'll look for it, but let's put a pin in that broken butterfly discussion. Okay. Does this make sense? Give me some Y's and yeses in the chat if this makes sense. So for this trade, the question is, how do I make money? If Meta continues to fall around that 610 handle, we get filled on this trade for a 240 debit. That's my pending order. If price by the expiration, if price is greater than 615 by my expiration, I make money. This trade will close out and fully expire at a $5 credit. I paid 240 for the trade, which gives me a 260 net profit. If I want to manage partial profit, I just watch and see what happens. If I paid 240 and the broker shows that it's up $100, well, I could close that trade out for $3.40 credit. I pay 240 debit. I'm showing 340 credit. I close that out. That difference is $100 or $1, and that's my profit. So where's my risk? Okay. If Meta is less than 610 by expiration, my trade loses the full 240 debit. That is it. So what's nice about this trade is this thing could literally fall, and Mark Zuckerberg can say, "Look, I'm an idiot. I don't think we're going to make any money in AI," and the stock drops to $450. It doesn't matter because all I'm going to lose on the trade is my debit. So the stock could literally tank down to April lows, and the most you can risk is what you are putting in for that defined risk trade. Another reason to think about, it's a pretty smart way to trade. This thing could drop 90%, 100%, and you're just going to lose $240. Okay. The thing could rally to infinity, where you're only going to make $260. It's defined risk on the downside and it's defined risk on the upside. But do you understand where this trade is at? Right? So what happens if price falls? Well, if it's below 610, I lose my debit. If price is back above 615, I make all of my profit. My break even, I saw somebody beat me to it. The break even on this trade, okay, where is my break even? Well, we take the 610 buy call plus the $2.40 debit is going to equal 612.40. So as long as Meta is at 612 or higher, I don't have a loss. Does that make sense? So if we are at, I'll put this alarm right here. If we are at, come down. If we are at 612.40 or higher, I'm break even or better. Ideally, I want the price to be back above 615 and obviously not having price drop below 610 or else I wouldn't be taking the trade. If I thought I was going to lose, I wouldn't take the trade. Okay. So I'm going to let this marinate and see if it does come down to fill me. Let's see if it does. And then from there, I will see if we can hold this level. This also is a nice little 50 to 60% pullback zone. So maybe the market bounces off of this rally from April to all-time highs, pull back to that like 50618 zone, and maybe that offers some support into the end of the year to gap fill. So we will see. I think it's a good trade. It's defined risk. I think it's worth taking a stab at it. Okay. Would you consider doing another broken wing butterfly? I did one this morning, Thomas. I didn't get it filled because I put it out where I wanted it to be. So I put in a bonus trade today. I put it in Zoom, my daily profit play. We're looking at $1 credit on a 70, like 70, 50, 70, 60, 70, 75. It was trading for like 10 or 15 cents. So I didn't get filled on the trade, but it's out there pending if I need it. Okay. All right. So I've got some Y's and yeses in the chat. This is making some pretty good sense on Meta. So this is a review of a bull call spread. So what I want to do now is let's pick an asset. Okay. Let's pick SPY or Qs or Mag 7 trade that everyone knows, kind of a household name, and let's discuss ways we can trade it. Okay. Let's do this. We'll use examples. We'll do this like with several strategies, and we'll use an example into the end of the year. Okay. So I'm gonna note this here. Let's go to SPY. Okay. SPY is trading at 682. Okay. Now, this is how we think about trading options. It's like a chess move. So the question that I'm asking myself and that you'd ask yourself is, do you think SPY will be higher or lower by 12/31 expiration? Answer that question in the chat. Do you think SPY will be higher or lower by 12/31 expiration? So from right now, October 31st, by the time we're talking about SPY December 31st, will we be higher or lower? What do you think? Okay, Thomas asks a good question. How would you manage it if it continues to fall? The most I can lose is $2.40. Meta could literally fall to zero, and the most I can lose is $2.40. So I don't have to manage the trade. It's if I get filled, the trade is defined risk at $240, and if I win the trade, I make $260. That's my trade. Okay, I'm seeing higher. I'm seeing higher. I'm seeing higher. Okay, higher. Fine. So consensus says we think it's going to be higher by 12/31. So let's price it out. Okay, we're going to price out the SPY and go to December 31st expiration. And right now the SPY is trading at 682. Okay. So if I look at my option chain and I were to buy, there's a couple ways I can think about buying a call. If I buy a call option at the money, I have to pay $19.10. Okay. So we can buy an at the money call for $19.10 debit. Okay. So that's a $1,910 debit. Okay. And that makes my break even. If we're buying the 683, okay, it'd be 683 as my call strike plus 1910. That makes my break even above $700, right? 683 plus 1910. My break even is 702.10 equals 702.10. So right now, what I'm paying for is I'm paying for this premium and the time in the trade. Okay, so I'm paying $19.10. I'll just use that as a simple number. I'm paying $19.10, and it's time plus the cost of the option because I have time in the trade of 61 days. So in order for this to work in my favor, I need price to go pretty fast up towards probably 690 to 695, like almost immediately in the next week or two, because here's my best practice on buying call options. Okay. So do you think SPY is going to go up? Everyone said higher, higher, higher. Okay, so if you do this as a strategy, you buy the at the money call for 19.10. Your break even is 702.10. Okay, to make money, this trade is 61 days to expiration. So realistically, you want price to rally within 30 days. Okay, to avoid the aggressive time decay that works against your trade. Okay. So if this trade takes 61 days, you need price to be above 702.10 to make money. So even if it goes from 683 to 700, you're going to lose everything in this trade. Because if it gets to 700 at the final stretch in this expiration, you're going to lose 100% of your debit. So you would lose $1,900 on this trade. Even though it went from 682 or 683 all the way to 700, you still lost money on the trade. But because you have time in the trade, the best way to manage time in your long call options is to cut this thing in half. So if you go out 60 days, you want profit within about 30 days. If you went out 30 days, you want profit within about 14 to 15 days. If you go out 90 days, you want profit within about 35 to 45 days. Okay. If you go out 360 days, you want profit within 150 to 180 days. If you want to reduce the losses and you want to, save some of these like terrible call option experiences a lot of traders have, cut the trade in half of time. Right? So if you want to go out in this case 61 days, I want to manage this trade for win or loss. This is like Tasty Trade 101 based on the mechanics of how, time works against you. If you manage this trade with half the time left, 30 days, take it off for a winner or a loser, because your losers will be smaller than full loss, and your winners will be manageable. And you're a little bit more capital efficient. You're reducing volatility dramatically. You're probably reducing portfolio volatility by about 40%. Okay. So that's a pretty good best practice, is if you're just going to buy a call option or you're going to buy a put option, you really want to manage those trades at half the time. So you go out 30 days, manage it in 2 weeks, 15 days. You go out 60 days, manage it in 30 days. Go out 90 days, manage it in 45. Go out 360. A lot of people love buying leaps. Pay for a 360-day call option, but you want to manage that trade at the 180 mark. Whether you're up or down, manage it. Okay, because your volatility, thank you. Look, the market goes up as it's designed to do, you'll make money because you'll have a lot of time premium left in the trade. But what kills traders is this. You start the trade here and you finish the trade here. Once you get to that halfway point in time decay, once you get to the halfway point, things start to accelerate. And then the last stretch, it gets really, really aggressive. So you have about this point, which is roughly that halfway point. So if this is time decay, once you get to the halfway point, things start going against you, where your value is pretty much dictated by you have to have price now above your break-even point to make money. Because if it's not above your break-even point, you're typically going to be fighting against time too aggressively. So manage at the halfway point. I think that's one of the best practices I can share. If you like to buy call options, you want to manage the trading about half the time you have in the trade. Type in crystal clear in the chat if that is crystal clear. That's a really good best practice. Okay, so that's one way we can trade this. We can buy the 683. Okay, so I'll put a 683 at the money call for 19.10. That puts me at a break even of 702.10. If within the next 20 to 30 days, we see price at 690, 691, 692, there's probably some partial profit in the trade. It may not be gargantuan profit. It might not be this awesome, like, man, I crushed it on the SPY. Well, if it offers 10% return, that's still pretty good. You're paying 19.10. If you can make 190 bucks, that's still a pretty good trade, right? If you make 20% return, you're making $200, $300, $400. That's not bad, but take the profit at that halfway point. Okay, good. All right. So that's one way we can do it. Okay. The other trade is, okay, that's a buy the at the money call, manage it in the time. That's a best practice for a long call option. The other way is a bull call spread. So I can buy the 683 call and I can sell the 684 call. Okay. Let's see what that debit is. If I buy this right now, I buy the 682, I sell the 683. The broker says I've got to pay 63 cents. Okay, I'll take the price. And like I said, on the indexes like this, the SPY and the Qs are typically more expensive than individual stocks. So the broker says it's a 63-cent debit. So that is my max risk. And then $1 credit is going to be my max credit, which translates into a 37-cent max profit. So I have some backwards reward to risk, do I not? So yeah, I can lose 63 cents. I can gain 37 cents. Why does this trade still work? Because the bias is bullish, right? We are talking large cap and market cap weighted. And let's say November and December seasonality can help price continue to go up. So you're basically paying a bit more for the drift that the market has. There is such a thing called positive drift on these indexes. This is what they do best. This is why bull markets last a lot longer than bear markets, right? From 2022's recovery, this is like October of 2022. It's now October 2025. We're in a 3-year bull market because once it bottomed in 2022 around October, we're up to multiple all-time highs. Okay. So that positive drift continues. The melt up continues. The market's made hundreds of all-time highs since that bottom. Right? Now, does it change? Does it always go up? No, of course, we have bear markets every now and then, but this is what an index typically trades for. My rule of thumb, okay? My rule of thumb is rule of thumb on a debit spread. So SPY, QQQ, even SPX, even NDX, if you want to trade NASDAQ, it's not as liquid, but it's still there. Is pay no more than 2/3 of the width. Okay, so if I have a $1 spread, pay no more than 66 cents debit. If I have a 250 spread, pay no more than, what is that, $1.20 or something like that? What's 0.66 times 250? $1.65. Okay, if I have a $5 spread, pay no more. And these are for debits, right? For a debit spread. If I've got a $5 spread, it should be like 330. 5 times 0.66, 330. And then a $10 spread, pay no more than a 666 debit. Does that make sense? Let me get this up into some white space here. Okay. Because it's going to be difficult to get filled at like a 50-cent debit. So I risk 50 cents to make 50 cents. It'll be difficult to get filled unless price is coming below your strikes. Okay. Which I'm okay with. You can still take those trades. I do like those trades, but it's more difficult to get those on the index related positions. Okay. On a stock, an individual stock, you can get these to be a little bit more fair priced. On a stock, you can pretty much go 50-50. If you buy something at the money, I'll show you an example. Let's trade Meta. If I trade Meta right now and I go out to December 19th, if I buy, we're trading at 647. If I buy the 645, sell the 650, I'm only paying 245 to make 255. That's the difference between a stock and an index, right? If I'm right, all I need Meta to do is stay above 650 by the end of the year, and I can make $2.55. If I go to Amazon, which just hit all-time highs, I go to December. If I buy the 245 and sell the 250, I have to pay 258 to make 242. It's about 1-to-1. If I go to the SPY, let's say that I go 5 wide out to December. If I buy the 682 and I sell the 687, broker says you got to pay $3. That's a little bit more than 1-to-1, right? But that's the positive drift that I pay for. Okay. Karen says, please explain why not a bear call on Meta? Because the market already dropped it. Why would I do a bear call spread? Do you believe that the market's going to stay down? I think the market is giving Meta investors a discount. If you like the stock, you like the cash flow. I think Meta's coming into a discount to have a better buy opportunity than it is to crush the thing to the downside. Okay, pros and cons of trading SPX versus SPY. SPX, you get the 60-40 tax split. So it's always divided with like a mix of long-term, short-term capital gains. So your tax benefit is instead of paying like 34% short-term capital gains like you would on SPY or QQQ, you get like a 21, 22% blend. So you get a tax benefit. It's also cash settled. There's no assignment risk. So SPX is just trading index, and there's no risk of assignment, which is good. Can you do a synthetic long here? You can do whatever you want. A synthetic long is a lot more risk than a credit spread or a debit spread. A lot more risk. So a synthetic, you got to be pretty confident that you've got a bottom in. If you want to go synthetic long, I mean, either put a hedge on or be prepared for, some drawdown if you're wrong. So I think a synthetic long is way more risky. Right? A synthetic long is you buy a call, sell a put. If price goes up, you get the benefit, but if price goes down, you're going to get assigned the shares, you lose on the call. A lot more risk on a synthetic. So you got to really love the trade if you're going to go synthetic and trade it as if you're buying the shares. Okay. So let's get back on topic here. If we pay for or if we're looking at the SPY, we think it's going to go higher. Consensus, I'm just, testing everybody in this session here. Everyone says, I think it's going to go higher, higher, higher. Okay, good. So if I were to do this trade, I buy the 683 call, I sell the 684 call, I pay 63 cents. Where do I make money on this trade? Okay, let's move this over here. Let's start another trade. So this example, a bull call spread. Okay, let's say I'm comfortable risking the $1,900 like I was on the long call trade, right? So how many contracts would that be? If I have a 63-cent debit, $1,900 divided by 63, I could take 30 contracts here, right? So if I have 63 cents of risk times 30, I'd be risking $1,900. So I'll use 30 contracts for this bull call spread. And now the risk is the same as the long call. Okay. If you trade one contract, your max risk is 63 cents, or that translates to $63. Your max profit is 37 cents, which is $37. Okay. So for anyone that has small accounts, can you totally afford to take this trade? Your max risk is $63. Your max profit's $37. If you're trading, I'm hoping you can take this trade and afford to take this trade. So that's what's nice about options is you don't need thousands and thousands of dollars to take these trades. This is defined risk. Worst case is I lose 63 cents or $63. Best case is I make my dollar and it gives me a net 37 cents or $37. Okay. So if you trade one contract, there's your reward to risk. If you trade 30 contracts for the exact same it would have cost you to buy a call option, what's our max profit? Right? If you trade 30 contracts, we'll do 63 cents times 30 or 3,000 shares, or the 37, which would be our profit times 3,000. This would be our max reward and risk. So what's 63 cents? I think it's 1890. So 1890. And if I'm right, I do 37 cents, 1110. Okay. So where do I make money? What is my break even? So if I buy the 683 call and I sell the 684 call, full profit is reached by the December 31st expiration as long as SPY is greater than 684. Make sense? So if we drift up to 684.01, if we drift up to 685, we drift up to 700, 710, 720, we're going to make our full profit here. Okay. My break even price is 683.63 because that's the debit. That's my 63-cent debit plus the 683 strike, which is my buy call option. So as long as price is above 683.63, I don't lose any money. All right. Where's my risk? My risk is max 63 cents risk if SPY is less than 683 by expiration. Is there assignment risk on this trade? No. A debit spread rarely, if ever, is assigned. Okay? Because I'm buying a call, I'm selling that call to cap the upside and spread it. You're rarely going to get assigned, especially to the downside, because you're long the option. So you're not assigned. Okay. I've had one instance where this year in March and April, I had a bull call spread and the broker assigned me short shares, but then I had the long call that offset it. So it's very, I would normally say there's no assignment risk, but it has happened to me. So I can't say ever. But does the math in this make sense? So all I need the price to do is stay above 684 and I can make money. That's a lot different break even, isn't it? If my break even is 702.10, if my break even is 702.10 on the call option, or my break even is 683.63, which one do you think gives you a higher probability of profit if you're just trading based on a line in the sand? If price can just melt up a little bit in the next 60 days, I'll take this trade. I don't need price to do anything other than drift up about 63 cents over the next 60 days. We all know the market's very capable of doing that, which also means that of the max 37 cents that I can make on the trade, of the max 37 cents I can make, it's also possible that that 63-cent debit is trading for 80 cents credit, 85 cents credit, 90 cents credit, 92 cents credit, where I don't have to wait all the way to expiration. So I can still take partial profit on the trade. And if I thought it was fair, it's like, hey, market went up. My 63-cent debit is now showing 90 cents credit. The most I can make for the remainder of the trade is 10 cents. And I've got to wait an extra 20 days to do it. Now you have a question. Do you want to just take the profit and grab 90% of your credit? Or do you want to wait and ride it out to the end of expiration and maybe give up just have more risk, I guess, if it's at the end of the expiration? If the most you can make left on the trade is like an extra 5 cents, sometimes it's not worth hanging on to it for 30 extra days, So I think capital efficiency wise is if you've achieved most of the profit, 85% of the profit, 90% of the profit, 95% of the profit, I don't mind just taking the profit off the table if it gives me a lot of time. Does that make sense? Okay. All right. Does this example make sense? Do we understand the difference of our break-even prices? Yes or no? If I buy the call option, my break-even is 702.10. If I do a bull call spread, my break-even is 683.60. Big difference. Okay. All right. I see a lot of Y's and yeses. I see some crystal clears. That's good. Okay. Let's do this. I'm going to move this up here. I'm going to move this over here. And I'm going to go into another section that we're going to do the same bullish directional trade, but now we're going to do a credit spread. Okay. We'll break it down the same way. Now we'll have this example is going to be a bull put spread. So this is a credit spread example. And what this will do is this will change our line in the sand. This will change our break-even price. Okay. So we still have the same narrative. Trade or SPY is trading at 683. We think it's going to go up in the next 60 days. So we believe the SPY will be higher by December 31st. So we want to now create a bull put credit spread. So how do we do that? I can sell. So I can go SPY 12/31 expiration. I can sell the 683 put. I can buy the 682 put. Okay. The broker's probably going to give me 35 cents to maybe 40 cents credit. Let's actually look at the trade and see what they give me. So if I do the 683 by 682, the broker says I can get 39 cents. Okay. I'll go exactly at the mid price. We'll say 38 cents. That's fair. So I'll make it a round number, or the number that the brokers actually give me, 38 cents credit. Okay. So that means this is my max profit. And I have the dollar spread minus the 38-cent credit equals 62 cents of risk. Does that math make sense? So the most I can lose is 62 cents. The most I can win is 38 cents. Now you can see that price-wise, it's very comparable, right? I was going to pay 62 or 63 cents for the debit spread. Now I just flip it and I'm taking credit on this trade for pretty much what my max profit was on the other side, right? A debit spread, I'm going to pay the 60 some cents. On the credit spread, I'm just going to collect the opposing side. So the most I can win is 38 cents. The most I can risk is 62 cents. My rule of thumb on the credit spread is aim to collect 1/3 of the width or more and it doesn't necessarily have to be at the money, but for index trades, at the money, because that's usually what the price is gonna be. Okay, so if I can collect 1/3 of the width, that works out. If I did a dollar spread, I need to collect at least 33 cents. Okay, I'm collecting 38 cents. Check the box. We collected at least 1/3 the width. So that would be $1 wide. So if I do a $1 wide credit spread, collect 33 cents or more. If I did a 250 wide spread, credit spread, collect, we want to collect $1.65. I don't know why this math, we'll go 0.66 times 250. Yep, so $1.65 or better. If we go $5 spread, $5 wide credit spread, collect 3.33 or more credit. And if we go $10 wide, that's not right. Is that right? Collect 1/3, so 0.33 times 5, $1.65. My bad. I did that incorrect. So this needs to be $1.65. And if it was 250, 82 cents. This needs to be 0.83. So collecting 33 cents on a dollar wide, collecting 83 cents on a 250 wide, collecting $1.65 on a 5 wide. Math is a little bit simpler for me. On the $10 wide is collect 333 or more. Does that make sense? Okay. You can see how there's that math correlation with the debit spread is something I'm paying for. The credit spread is something I'm collecting up front. Okay. Now the big difference here is where our break-even prices are at. By the way, let me check something really quickly. I want to go Iron Fly. I'm curious how that 6850. Larry, how's your Iron Fly doing right now? So that trade for 6850 is now trading for over $500 profit. So over 500. The other two trades were risking, trying to think, 500. And now it's tricky. Like this trade, 6,900 is only a $90 risk. This one's down 350. So I'm still like, I mean, I'm up $500. I'm down $300. It's going to make some net profit. It is what it is. Like The best way for this thing to settle at the end of the day is for this trade, the 68.50 is trading for 12.70 right now. I want this trade to be sitting around 68.50 in the next hour. If this trade is sitting around 68.50, this trade is worth $1,700 profit. And I was risking, 500 on one trade and $90 on one trade. So that's a big fat profit if I could walk away with over $1,000 today. So it's not done. I mean, there's another hour left in the trade, but I'm also not playing games where it's like I just took net profit on the day. So I'm just always curious, like, how do you manage these trades into the close? I'm always pretty happy making a couple $100 on profit. And I know as I let it kind of unfold through the day, it's always interesting, like, man, what a crazy move. It's like we pinned it. So obviously the more I start taking these trades and taking these profits, I get more and more confident of my willingness to hold it through late in the day. But I never minded. It's like, look, I was risking about max about $1,200 a profit, or I'm sorry, risking about $1,200 today, and I walked away with $100 profit, or I guess between daily profit play and my butterflies, like I walked away with about about $200 profit. So it's not a huge return on the day, but still, money's in my hands, profit on the day. But now the day continues. So if we sit here and just kind of bounce around between this like 68.50, 68.45 zone, I don't know what's going to happen. Obviously, we can sit here and fumble around for the next hour, or we can come all the way back up. And maybe the better trade is like we need to get that 6,900 trade in. So it's just a lot can happen in the final hour. A lot can happen in the final 30 minutes. A lot can happen in the final 5 and 10 minutes. So I'll just kind of spot check this as we continue through our session today. All right, let's go back to this. Now let's talk break evens. Okay, where is the break even? Where do I make money? And where do I lose money? So my break even is 683 less the 38-cent credit. So 682.62 is my break even price. As long as SPY is greater than 682.62, I'm not losing money. Okay. If SPY is greater than 683 by expiration, I keep the full 38-cent profit. If SPY is less than 682 by expiration, I risk the full 62 cents risk. Does that make sense? So here is it takes a lot of explanation here to walk you through. This is the biggest difference to me on why I trade spreads versus long options, because let's assess this based on the break even. On a long call option, my break even is 702.10. On a bull call spread, my break even is 683.63. On the credit spread, my break even is 682.62. What would you rather have as far as the market's ability to be a little bit higher in the next 60 days? Would you rather have a break even of 702, a break even of 683.60, or a break even of 682.62? This trade or this trade, to me, as an instrument that is built on positive drift, I'd much rather have the break evens be pretty much at the price of the asset, because it is much harder to bank on prices going up to cover the cost of that premium and cover the cost of the time, especially if you don't manage the trade properly. These trades, if price goes higher, you get profit. If price is going to stay higher, you get profit, right? Credit spread, I mean, it's going to be about the same. The difference is, yes, your break even is a little bit better. What's the trade-off? The debit spread, you rarely, if ever, have assignment. A credit spread, you might have assignment risk if something really, really drops to the downside. So if the SPY, for example, were to drop to like 650, okay, you would be on the hook for the broker to say, this trader has a 683 sell put. You are obligated to own the shares at 683. Okay. So that's the only thing that deters traders from, hey, I don't want to do credit spreads because I never want assignment risk. If you never want assignment risk, then don't trade the SPY. Don't trade the Qs. Don't trade individual stocks. Trade the index. Trade SPX. It's cash settled. There's no assignment risk. Trade XSP. It trades just like the SPY, but it is cash settled. Okay. So that's ways to work around the assignment conversation. All right. So just based on break evens, we know there's a big difference between if price is above 683.63, I make money, right? If price is above 682.62, I make money. Versus I need price at expiration to be above 702 to make any money. That's a big difference. Okay. All right. Does that make sense? So we're talking through examples. It's the same asset, the same at the money trade, but very different break evens, very different needs. Like I need SPY to go up if I'm doing long calls. I need SPY just to drift a little bit higher for the bull call. I need SPY to basically stay where it is and drift a little bit higher to help me out and make money on the credit spread. Okay. If I wanted to buy this call option, I don't have a choice. I can't make this any cheaper. A call option out to December is $1,900. If I traded a spread, I only need $63 on this trade. So it is way more cost effective to get that return, right? Literally, like I can't give you a return on risk probability if I do a long call. I can't because I have no idea if price is going to go anywhere. And if it goes nowhere, I make $0 and I'm just risking $1,900. I can tell you that the probability of this thing going up above 683 is probably about 55% just based on the positive drift in the market. So you already have a house edge. Price just goes a little bit higher over time. Okay, cool. That's why it works. That's not exactly true. No, 683 equals 6830. It's not exactly true. Okay, if I go 6848, okay, that would be like putting the SPX at 6848 would be the SPY at 684. It's not quite there. You can see there's a bit of a disconnect, or I mean, you could argue like, oh, it's a discount. It's not. It's just there's a slightly different trade. Now, the XSP, you can see it's pretty much the same. 684, it's at 683.99. So SPX versus XSP, that is a little bit more on point. The SPY is a little bit different. Okay. Okay. So long call, bull call spread, credit spread. Silly names, but what I want you to take away from this is, do you understand a debit spread versus a credit spread? And do you understand how dramatically different the break evens are compared to just buying calls? Because now you're equipped with 3 ways to trade the market. If you want to trade the market up, you can always buy calls. Unlimited upside, price has to go your way. But to manage the trade effectively, the best practice, in my opinion, is you got to manage the trade about halfway through the time of the trade. So if you want to go out 30 days and buy call options, you're going to have to make a habit of managing those things about 15 days in. If you don't, you're fighting time and it's an uphill battle. Bull call spreads, just need to cover the cost of the debit. Bull put credit spreads, you need to stay above that, your strike minus your credit. That's your break even. As long as you stay above that, your break even or better. Basically, you just need to stay above your sell put level and make money. Okay. All right. So what's nice about this is we can do this all to the upside and we can flip all this around and go to the downside. So if I wanted to go to the downside, okay, if I want to go to the downside, all I'm going to do is buy a put and it's this in reverse. Or I can do a bear put spread and that would be a debit spread and it's this in reverse. Or I can do a bear call spread and it's this in reverse. Okay, so I'll go up a little bit higher. So down here, so these are here. Bullish trades, right? These are bullish trades. Everything we just talked about is all to represent a bullish trade. Now I'll go bearish. Okay, and I can be a little bit faster here because if we get the concept of I'm buying a put, I'm creating a debit spread. I'm creating a credit spread. It's just working to the downside. So if I believe, okay, and this would be the question, like I said, do you think the SPY will be higher or lower by December 31st? And if the consensus is, Chris, this market's going to drop, this has to be lower, let's talk about it. Okay. If we believe the SPY will be lower, then here is what we can do. I can buy a put. I can create a bearish debit spread. And I can create a bearish credit spread. It's 3 ways to still trade the market. It's 3 ways to calculate our break evens. As long as the SPY goes down, we have a chance to make profit on these trades. Okay. So let's do the numbers. If we think it's going to go down, let's go to the SPY and go out to December 31st. If I buy a 682 put, it's going to cost me $15.50. Okay. So this is a $15.50 debit with the 682 strike. Is that what I chose? 682 strike. So that's kind of at the money. You want to pay a little bit more? There's a $15.95 at the money. We'll do that. So we'll say it's a $15.95 for the 683 strike. Okay. And that is 61 days to expiration. So my break even is 683 minus 1595. Let's do the math on that. I need price 683 minus 1595. I need price to be below 667. 667.05 to guarantee profit by expiration. Okay. If price falls quickly, I have enough time in this trade to see return and partial profit. So I can turn a $15.95 debit into maybe a $17 credit, $18 credit if we drop, 5 or 10 points in the next week. You can get some quick profit on it, but you got to manage that trade pretty aggressively. Okay. How do we close call Gilead 120? I mean, I don't even know where that trade came from. Whose trade is that? Why do a credit spread versus debit spread? I mean, it's really a preference thing. I think a lot of people choose the debit spread in order to avoid assignment. If you're trading stocks or SPY/QQQ, you do a debit spread to avoid assignment. I personally like credit spreads, especially when it comes to indexes, because I like the idea of it's not a debit, it's a credit, and I give myself a slightly lower break even or an improved break even, I should say. So I don't know. I prefer to do credits over debits. Rogers. I mean, I'm not in Gilead, man. Like, that's not my trade. So ask Roger. I mean, I don't know. So call 120, 1031 call. I mean, where's price at? And I mean, I shouldn't even be talking about this. This isn't my trade. Gilead Sciences. We're trading at 119. So what are you doing? A 120 call that expires today, it's probably worthless because price didn't cover the cost of your trade. So you're going to lose on that trade. If you did a long call, you need price to be at 120 plus the cost of your trade. That's your break even. So it's 119.54 the day of expiration. That thing's worthless. You go out to the 7th of November, same thing. 120 is your strike. Add the debit to it. That's your break even. If it's below that, the trade's worthless. Okay. All right. Back to this. Okay. So does this buy put make sense? I can spend $15.95 debit and I buy the at the money put for 61 days, it's going to cost me $1,595. That puts my break even at 667.05. That is, if price is below 667.05 by expiration, I at least have a break even trade. I at least make some money on the trade. But ideally, if price falls quickly in the next week or so, by the time this trade is out 61 days, if I'm managing this at like 20, 25, 30 days, I reduce the volatility. Maybe I get some profit on it in the near term and take the partial profit. But that break even is 667. Okay, that's one way to do it. Why do people love buying calls and buying puts? Because they're told there's no profit cap, unlimited profit potential. It's true. But the reality of prices moving in a huge surprise move is slim. And that's what you're up against. You're not going to get a bunch of these crazy surprise moves in an index. You're going to get a lot bigger surprises in individual stocks around earnings, breaking news, major catalysts, maybe some wild and crazy wonky stuff fundamentally. So stocks have a lot more surprises to the upside or downside versus indexes. Okay. All right. Let's talk about a bearish debit spread. So a bearish debit spread, this would be, we can buy the 683 put and we can sell the 682 put. And on this one, we probably pay like 50 cents. It actually might be better. Let's find out. If I buy the 683 and I sell the 682, I mean, this actually is really good. The problem with this is we're playing against the grain. The market is built to drift higher. It's cheaper to take this bull put spread or this bear put spread, but most likely, if we give the market time and seasonality and it likes to drift higher, this is going to be a losing trade. But it's cheap, so I don't mind it because you'll see the potential. So it's a 37-cent debit, which means my max risk is 37 cents. My max profit is 63 cents on the $1 wide spread. Again, my rule of thumb is for the debit spread is I would say for debit spreads, and it could be the same thing applies because obviously when the VIX is higher, when volatility is higher, you're going to pay a lot more premium for that protection. But the rule of thumb on debit spreads to the downside is generally pay half or less for the spread. So a $1 wide debit spread. Okay, on the put side, so bearish trades, $1 wide debit spread for 50-cent debit or less. 250 wide debit spread for $1.25 debit or less. And you get the math. $5 wide debit spread for $2.50 debit or less. And $10 wide debit spread for $5 debit or less. And generally, if we have a lower VIX, it's pretty inexpensive to have protection. Okay, this is why I have an entire class around hedges. My Crash Insurance Masterclass. We take very cheap, very inexpensive hedges that offer some really good upside potential. Okay, everybody follow me right now? So what's the break even on this trade? The break even is 683 minus the 37-cent debit. So my break even is 682.63. So as long as SPY is moving lower and is below 682.63, we are break even or better. Again, this is expressing that you want to be bearish in the market. Make sense? Okay, I'm going to move this other one over here. And now we'll do the credit spread. Now we'll do a create a bear call spread. So I sell the 683 call and I buy the 684 call, and that creates a line in the sand at 683. And this broker says you can probably get about 65 cents credit, maybe 63 cents credit, give or take. I'll price it out and tell you exactly what the real price is. So on the call side, I sell the 683. I buy the 684. The broker says you can have 63 cents. It's the exact opposite of the debit spread, but I'm just collecting credit. But the break even is different. 63 cents credit, which means my max profit is 63 cents. My max risk is 37 cents. My break even is 683, which is my sell call plus the credit that I received. So 683.63 is my break even. As long as SPY is less than 683.63, I keep the full, well, I should say, I don't lose money. If SPY is less than 683, I keep the full 63 cents. If SPY is greater than 684, I risk the full 37 cents. Does that make sense? Again, let's go back and talk about the break evens. Okay, so the break even on a long put, my break even is 667.05. On a debit spread, my break even is 682.63. On a credit spread, my break even is 683.63. All of these require the SPY to go down, but obviously this one requires the SPY. The long put requires the SPY to go down way farther and way faster. This is, well, we could go sideways for 50 days. We could go sideways for 50 days. And in the last 10 days of this final trade, if we're out 61 days of expiration, we go sideways for 50 days, right? And then the final 10 days it goes down. Guess what? You covered the cost of your debit, you get paid. You covered the break even on your credit, you get paid. All price has to do is be below the line in the sand. So if we're less than 682, we keep full profit. If we're less than 683, we keep full profit. That's a lot different than requiring price to get down below 667. Right? Okay. Does the math make sense? So now we literally have a way to trade the market up, the market down. You can choose whatever you want. You're not going to have me tell you what's best. I will tell you that my preference is I like to do debit spreads and credit spreads way more than buying calls and buying puts because my break evens are way tighter and way closer, and I can also manage my risk. That's way more risk management, if you ask me, versus automatically just paying a huge lump sum just to take a stab at the market. I don't like to do that. So I don't. I rarely take full on like long calls or long puts unless I'm going to go out longer term and then, sell premium against it. Okay. All right. How are we doing? Is this making sense? Give me some crystal clears in the chat if this is making sense. So it's 3:24. We're live for practical options. We're also watching the markets in the final hour. Price is up to 68.57. A pretty noisy day overall. Good profits on daily profit play. Let me see how those iron butterflies are doing. So I'll delete this. I'm just curious for entertainment purposes here. So the trade that was centered around 68.50 is now trading for 12.65. It's still up about $500. Okay, not bad. It'll settle in the final 30 some minutes. There is risk on this trade though. If price is greater than 68.75, I'm going to lose everything on this trade. So then the overlap is the 6,900 when I only went down to 80. So again, the weak spot that I had is if we come all the way back up to the highs around 68.80, I might have nothing to show for this trade. So I managed partial profit. This trade at the 68.50, my max risk was 7 and change. I think it was 725. So this trade, 725 max risk. Actually, yep, that's right. And then the 60, this 6,800, I think my max risk was $5. And the 6,900 was only 90 cents. So this is my risk in yellow. Okay. and my reward will be in green. This one potentially pays 910. This one pays 1775, and this one pays $25. So much bigger risk, or I'm sorry, much bigger reward than risk, but it's all about where this thing prices out. So yeah, Larry's got it spot on there. I mean, if we go to 68.50 and settle, I think ideally this trade would be great if it was a 68.55, 68.50, 68.45. That'd be pretty perfect. Because if it settles within about $5 of that price, I'm going to make 12.25. So I don't lose on this trade. I actually make 12.25. I could lose 500 here and lose 90 here. I can make 12.25, risk the 590, and still walk away with almost $700 profit. But if price continues to leak higher, there's risk in that middle trade. And I want to see if this one's like, I mean, this is a great profit potential, but this one has to go all the way to 6,900. And that is a tall order right now. I mean, based on the expected move in the last 34 minutes, I don't think we're going to this. 6,900 is up here. It's way out of the way. So, yeah, I'm always, this is why I'm always curious. Like if I take partial profits, I'm always kind of managing the trade, even though I'm out of the trade. I took profit on it earlier, but I'm still always curious, like, how does this stuff cash settle? How does this stuff play out through the day? Should I have waited longer? You know, I try not to beat myself up when I'm taking profit, but still, I'm always curious. But look at what price is doing. Price is floating higher. We're now back into positive gamma. We came down to gap fill here, bounced all the way back up, slow melt up back into positive gamma. You know, this is the end of the month. I always say this, like end of the month, there's sometimes some wild and crazy shenanigans of volatility, but where did the market start for the day? We started here, plus or minus was about 40 points. There's a plus 40. There's a minus 40. Okay, we started around 80. We came down to 20. So price moves 60 points lower. And now we're back up to within, let's say 80 to 60. We're within 20 points. So we're within 20 points of where the market opened today, which is, again, market makers doing exactly what they should do, keeping prices contained every single day. Most of the time they do. Okay. In fact, this week, it was like everything was pretty much contained. So this is what my daily profit play is all about every single day. Okay. William says, this is YouTube. So after a few hours, you can replay this program, stop it, copy the notes. Yep. This will be automatically archived in my YouTube. What I will do is I will download this recording from my Restream software and I will post it inside my Telegram as well. So you can always see it on my archive YouTube. I'll change the thumbnail, make it another strategy session. I'll kind of put like a strategy session with the Practical Options logo on it. And, we're kind of doing a full on, if it's a 2-hour workshop, so be it. It's fun. Okay. But yeah, I'll post a recording in Telegram if you want to review it. You can also watch it at, 1.25 speed or 1.5 speed. I sound like a chipmunk because I already talk fast, but you get it. Cool. All right. Larry, odds of this thing going, I wouldn't be surprised, in all honesty, just watching this momentum to the end of the day. I wouldn't be surprised if this market continues to drift all the way back up to where we started the day. I want it to go down. I hope that it does. I hope this like sticky point is where we settle. Like I said, 55, 50, and 45 is a big fat winner. If we're going to go higher, honestly, I mean, my pin was 6,900. So again, I'm curious just how the day settles. But a nice little rally here and then a pause and maybe settling and closing by the end of the day would be pretty nice. What if you had a tool that gives you direction to short impulse of the stock? You don't know the amplitude, the length of the surge. Would a simple call put be more appropriate? What if you have a tool to give you direction? I mean, build it for me, Thomas. I mean, look, everything has odds. Everything has odds. So if you want a tool looking for short term, I mean, my pinch point scanner. If you take my pinch point scanner, I like to use that for like really reliable swing trades, 30, 45, 60, 90 days out, very high probability direction. I think the hardest thing, unless you're going to be like literally like a, 1 minute scalp trader trying to read, flow tape every day. I mean, you focus on one stock and you trade that way. But I'm talking about the broader market, I like to see when things are coiled and volatility is ready to move and give it 30 to 60 days. And usually it does. Those trades work really well. Um, the only thing I like to do short term is this. I like short term trading on 0 DTE with index options because we generally can call the tops and bottoms through the day. We generally can side with market makers on the day. That is to me a more reliable way to generate income versus trying to trade direction. Most of the time, direction in the markets is going to be news based or it's going to be overnight crap, not during the day. If I were to give a statistic of like how many times does the market move a lot during the day, it's usually moving after hours. Gaps higher, gaps lower because of earnings. Gaps higher, gaps lower because of futures. Gaps higher, gaps lower because of option flows off hours. So, I don't know. I just think it's very, very difficult to consistently find direction that is I've got to be long an option in order to get paid. I've got to be, long a call, long a put to get paid. I personally don't like that. Okay. By the way, do you have a service that trades these two leg spreads? Lots of them. So I trade daily profit play. We do 2 legs and 4 leg trades. Waterfall income, we do 2 and 4 leg trades. Newsbreakers, we do 2 and 4 leg trades. Double ups, we do 2, 3, 4 leg trades. Pinch point, we do 2 to 4 leg trades. Crash insurance, usually 2 leg trades. Project options edge, usually 2, 3, 4 leg trades. Practical options, I'm trying to teach the foundation. Full course, teach the foundation with 13 strategies. So here's what they look like. Here's a quick guide. This is $27. It's a video series for $27. There's a 30-page PDF if you'd like it. You can hit me up on Discord or send me an email and I'll send you the PDF if you buy this. You can buy calls, buy puts. It's like a short version of what we just talked about today. Bullish spreads, bearish spreads, literally what we talked about today, and just one easy to follow video format. Okay. The full course is more strategies. And I built the full course for anybody that wants to learn how to trade options from start to finish. Look, I've read a bunch of textbooks. I've traded options for over a decade. When I started to trade options with the income potential instead of just buying puts for protection and selling calls for some premium and some income and lowering my cost basis, I started adding a lot more dynamics to trading options. And I started to be a much better portfolio manager when I started incorporating options. So key terms. This is where I do, the what's it called? The housekeeping. Hey, we got to cover this stuff. Here are the things you see industry standard: buying calls versus selling calls, buying puts versus selling puts. What about Greeks? What about Delta? What about Theta? Right? What about Vega? What about Rho? What about Gamma? All these things. It's like they're annoying. It's a learning curve, but I still subscribe to industry standard stuff. It's just not practical when it comes to making this simple to learn. So I still go through it, key terms, things that I've traded over the years to kind of accelerate that learning curve. Risk graphs. If I put on a trade, what does it look like on a risk graph? If price goes up or down, where's my break even? Do I know where I make money or I risk money? Looking at in a visual format. The option chain. One of the most frequent questions I get is, I have this broker. I trade with E-Trade. I trade with Fidelity. I trade with Webull. I trade with Robinhood. I trade with Tasty Trade. I trade with Thinkorswim. How do I find that trade? I navigate like 4 or 5 different brokers in this one. So they're pretty much the same. You find your underlying asset. So here's what an option chain looks like. Okay. You find your underlying asset. We talked about the SPY today for these examples. Here's my underlying asset. Now I choose my expiration. All these dates, if you follow my mouse here, all these dates are the expirations. Okay. So these are my expiration dates. This is the days to expiration. So this date coincides with how many days that trade will be open. And then once I open it up, I have the volatility and the expected movement for that particular window. That's the plus or minus. So if I go SPY out to the end of December, the broker says right now with current volatility, the broker says we should have a plus or minus 33.59, which puts us up around 717, as high as 717 and as low as like 650. That's the range that we could see the SPY go. Options markets are very smart and very efficient. Okay. So we will see what happens, but ultimately that's what the market, is trying to adjust. And This all changes dynamically in real time. Market makers are some of the hardest working institutions and firms in the world. They have to provide liquidity. They have to take pretty much the opposite side of every trade. They make a lot of money by prices staying in guardrails. They like to sell calls really, really high. They like to sell puts really low, and they like to contain prices to create efficiency. That's an efficient market. That's their job. If prices push higher than their sell calls, they have to hedge in order to not lose money. If prices push too far to the downside, they have to hedge in order to not lose money. And they do this all the time. So don't think that it's always a guarantee that the market's going to stay in a range. Like this year, we've had a lot of excess upside drift where, I trade this stuff every day. I see a lot of upside risk, right? The market's like, case in point, every quarter, JP Morgan has an investment arm and they put out about a 10 to 15 delta call option and a 10 to 15 delta put option. And those act as ceilings and floors every quarter. For the last 2 quarters, we have blown through the upside. And so what it forces market makers to do is to hedge into those levels to make sure that if they're selling calls and they're stacked up a bunch of premium there, that they're not going to get blown through without having some offsetting risk, right? So anyway, option chain. These are your dates. This is the time to expiration. Here is your volatility of that asset with the plus or minus range. You go into a certain strike. We use that 12/31 expiration. Now, you see that I have all these strikes, which is the price of the asset. It's at the money when you're talking about the actual price of the live stock or asset, right? So SPY live is 684.35. At the money is going to be the 684, 685 strikes. If I am going to buy a call, that's an at the money call. If I'm going to sell a call, that's an at the money call. If I'm going to sell an out of the money call, I would go higher in the option chain and I would sell something out of the money. Hey, look, I buy the SPY at 684 and I sell a 700 call. Let's say this happens. Totally hypothetical, but if I buy shares right here and I sell this call, so I buy shares at 684, I sell a call for $10.20, and I need price to be greater than 700 by expiration. Okay. It's just a trade. What I've done right here is I've lowered my cost basis down to 673.80. And if shares are greater than 700 by expiration, I get the shares called away at 700. So I make $26.20 profit instead of, if I was to just see price go up to 700, I would make $16 in gain, right? I make $16 per share here. I make $26.28 per share here, right? Now, if price goes to 710, 715, 720, I cap my upside with this trade, but I'm also going to have to sit and hope that it goes higher. So anyway, this is like buying shares and adding a cover call. Anyway, I talk about a lot of stuff in my practical options. So full course looks like this: risk graphs, navigating several option chains. They all look about the same. I've traded with a handful of brokers here with all different options. I have a Webull account. I had Robinhood. I have Tasty. I have Thinkorswim. I use the web platform. I have Schwab. I've looked at all of them. They're all pretty much the same. Strategy guide. This is a 70 plus page strategy guide. Again, just reviewing a lot of the strategies here with some live examples, and then going through videos, buying calls and buying puts, bullish spreads, bearish spreads, calendar spreads, diagonal spreads, butterfly spreads, and directionally neutral strategies, which include the strangle and iron condors. So it's a lot of stuff packed into this course. Okay. So, if you're interested, you can always hit me up, ask me. Email for a lot of followers, chrispulverpub@gmail.com. I'm live every single day in my daily profit plan. I'll share any of my links. If you want a course, if you want support, if you want to ask about any of these courses, just send an email. Okay. Here is the team email. You can email support@prosperitybub.com. You can give our team a call. You can email me. I'm happy to help. Okay. Dynamic trend. I use the software every single day. This software is my visual roadmap every single day. It helps me a ton. Okay. Again, you don't have to get it. I subscribe to it. I had it as an institutional member, and now that I'm retail, I get a little bit of a break from it. Like enterprise wise, it was like close to 10 grand a year. Now it's like 3,600 for me. I have a package that the team put together for me for 945 that gets me this like zero DTE. So it's, I mean, I'm able to save people if they get the link through me. You can save 3,000 bucks. Not bad. So it's like 945 for the year, but this helps me make decisions every single day. Okay. Larry, you took the profit, 50%er. Not bad, dude. Not bad. Which software did you say you used to download this session? Well, I will download it myself. I will download it and I'll post the video inside my Telegram. So if you are in my Telegram, okay, if you're in my Telegram, which you can join here. So this is my Chris Pulver Telegram. If you're in my Telegram, I will post a video link here. So when it's done, I'll just have a direct link and you can just click on it and play the video. So it'll be a long one. It'll be, 2 hours or whatever when it processes. But have it. It'll also be on my YouTube channel and I'll label it so you know where it is. Okay. All right. 68.59 is my break even. So I took the 500. I mean, that's still pretty good. How many contracts you do, Larry? What'd you pay on the trade, by the way? What did you say earlier? You did a butterfly spread, right? You were risking like $1. Did you risk $1 on that trade? My debit spread on the $1 would show a debit for 64 cents. So how do you come up with the debit you told us? What are you referring to there, Chuck? 10 contracts. Okay, gotcha. Yeah, so $1 on 10 contracts. I gotcha. So Chuck, I'm asking you that question. My debit spread on the $1. I'm not sure what you're referring to. Are you referring to one of these trades? So we either have and I'm assuming like if you're talking about dollar stuff, then it's going to be a debit spread or a credit spread. So give me some more details, Chuck, and I'll try to answer your question. All right, as we come into the final 17 minutes here, what is that iron butterfly doing? Just for fun, iron butterfly. This was so we're at 68.65. So now it's up about $225. So I do need, I mean, if this was going to pay more at the end of the day, I need price to fall back down to like 55 or 50, and that would be pretty spot on. But if we slip up to like 70, 75, 80, I'm taking in way less profit on that trade, and I'm basically giving full losses to the other ones. So net, I'm actually pretty happy, and it's obviously a lot less stressful, not like scrambling to manage these trades at the end of the day. All right, so we still have 60 minutes left. Okay, very quickly, let's go back here. I'm going to delete some of these notes. Okay, you can go back and review this stuff, take some screenshots if you need to. Buying calls, buying puts, adding spreads, bullish and bearish. It's helpful. Okay. The thing I want you to understand is let's talk about all these trades. I'll put literally every trade we just did on a visual form. So let's go build a trade out. Let's talk about a long call. Okay, we'll use the same example. So this can all kind of drive the lessons home today. We said SPY December 31st. If I buy the 683 call, right? That's what we did the example on. Take a look at this trade. Okay, people see this and they're like, "Oh man, unlimited profit potential. I'm going to buy a call." But what you don't realize is in order to make money, you're paying $19.50 on the trade, which means this is your current price. You're tacking on almost $20 of premium that price has to overcome in order for you to start getting paid. Now, yes, the real trade could do something like this. If price moves aggressively higher, can you see this? At expiration, you can see that my break even is the asset plus my premium, this is my break even. But when we have time in the trade, if we see the SPY quickly move to 700, can you see that this trade is going to offer some profit? Yes or no? So let's say if by Monday morning opening bell, let's say we have this ridiculous gap higher on Monday morning. So Monday, what the hell? I'm skipping a week on accident. Here's Monday morning. Okay, November 3rd. Okay, if Monday morning the market opens at $700, this trade, because there's still a lot of time premium left, this trade could be offering me $800 to $1,000 of profit. That's awesome, right? Because I have so much time, it's very valuable instantly. But the longer I have to sit and wait on this trade, you're going to see that my break even starts to shift further and further to the right, because now it's all about what I actually paid on the trade. So the longer we go, and remember, this is out 60 days. So I said, manage this thing around 30 days. I will give you exactly where price needs to be to manage this trade. Okay. If we started the trade here with that $19 debit, you would want to see price realistically from a 684, 683 call. You'd want to see price probably around $700 or higher to consider managing some profit. Because once you're at that halfway point, the good thing is you're not taking on full loss, right? If price didn't go anywhere, you're not taking on a full loss. But as price goes on, you're going to see that this red part of the trade will sag lower and you're going to take on full risk. Okay. And then the right side of the trade is going to push further to the right because you have to cover the entire cost of your trade to make money. So watch the difference as time goes on. We get pushed further to the right and the red sags even further. And now at the end of this trade, if price has gone nowhere, you're losing everything. If price even goes to $700, you get direction right. I bought a 683 call, price went to $700. I still don't make any money. That to me is the best way I can visually show how frustrating it is to buy a call option and not get paid. Okay. Chuck, I still am not deciphering like what you're telling me. How did you come to debit? You just told us on what trade? Like, I'm not sure what trade you're talking about. I've just done nothing but examples today for the SPY. So if you're talking about like an iron butterfly trade that's like not related to practical options, that's more like I did that in double ups. So I'm not sure what you're talking about. Give me some more details, man. I can't decipher what you said in one comment. All right, 68.59. We've got 12 more minutes. Yeah, this thing might come back to 55 or 50, which could be kind of a lucky little pin. Let's see what happens. It's kind of sticky around 60. Okay. All right. So here's a call option, right? So everyone sees a call option. They're like unlimited profit. That's why they take the trade. They get, it's the appeal of you can't cap the upside. It's great. A lot of people, you might see this on YouTube, buy deep in the money call options. Yeah, that's great. It's cheaper than buying stock. You still need the asset to go up though. But what you do is you take away a lot of the power that time plays against you. So that's a good thing. But it's really expensive. You want to buy an in the money call option, you're going to pay a lot more money for it, but you can kind of take away some of that time sting. But it's a lot more expensive. It's cheaper than buying the asset, but when you buy the asset, time is not a factor. You can buy and hold something forever, right? All right. Now let's take the bull call spread. So if I buy the 683 call and I add the 684 call, now look at the difference. Can you see that now the trade is defined risk? The most I can lose is this, a debit of 63 cents. That's the most I can risk. That's a big difference, right? I go from paying $1,900 for a trade to now risking $63. So this is why options can be really cost effective for anybody that wants to learn how to trade. You don't have to have a lot of money. Okay. So my risk is capped. The SPY could literally drop 20% in 60 days. It can drop 100%. We'd have some big problems that happens. but the most I can risk is $63. However, the trade-off is I can't gain anything else to the upside. So if price goes to 700 or goes to 720 or goes to 750, I'm not going to make anything more than my profit here. But that's okay because I cap my risk, I cap my reward, but the positive drift should help me get a house edge where I get this thing to pay me profit. So then I choose how many contracts I want to trade to define my risk. If you're like, you know what, Chris, I'm comfortable risking about $100. Well, either take one contract and risk 63 or take two contracts and risk 126. And your winner, you'll make $74. You risk 126 to make 74. And you don't have to take a big trade. You don't have to take a debit for $1,900. You can risk $100, right? Okay. Or I turn this into a put spread. So let me delete this, switch to a put. Now I sell the 683 put and I buy the 682 put. It looks very similar to a bull call spread, but my break even is down because I'm pulling in a credit. So now my credit is $36 and my net loss would be the 64 left. $1 is my spread. So this is the width. And I pull in 36 cents credit. Okay, so the broker gives me that credit. As long as SPY is greater than 683. If it's greater than 683 at expiration, I keep the full 36 cents profit. If it's less than 682, I'm risking the 64 cents down here. So it's similar, but again, defined risk, defined upside. I'm capped both ways. I can't lose more than this. I can't make more than this, but it's a pretty good trade, right? And now you can figure out, okay, if I want to risk X amount, take as many contracts as you want. So if I've got traders that are comfortable with, thousands and thousands of dollars of risk, and that's totally fine. Okay. For me, my comfort zone is like anywhere between, sometimes I take really small trades at like less than $100. Less than $100, everything is pretty insignificant to me. Okay. Anything around like $500, totally manageable, barely flinch. When I get to the $1,000 to $2,000 risk, that's stepping into like that half 1%, 1%. I know that if you give me enough trades, I'm obviously going to make up lots of winners from that range, but I don't like to take risk that's bigger than that because all that does is it digs a deeper hole. If I'm taking like swings of 5 and 10K on a $100,000 account, I can't afford to be wrong very often. So I take swings that are really small, almost insignificant, and I win a lot more trades than I lose, and that's how I make money. So, look, I like to trade. I like to win. I try to create option strategies where my probability of profit is high. My risk reward is fair. I'm not going to say it's always favorable, but it's fair. So to me, there's always a trade-off. If you want more reward to risk, you're going to sacrifice probability of profit. You want high probability of profit, you're going to take on more risk than reward. That's usually the trade-off. Options isn't really give me this crazy edge. You have to have a trade-off of risk reward. If you want a super, 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 super high win rate, you're going to take on excess risk. Okay. But if you want a super high reward to risk, you trade the probability of profit. But you can still make money. A lot of ways to do it. Okay. So more fixed style of trading? Absolutely. Like when I started to incorporate options, this would have been like 2012, 13, 14, when I started to get really heavier into options. I went from, owning shares, buying puts and selling covered calls to then doing more spread trading and just straight up defining risk. Because I thought, look, if the S&P can go up in a bull market, all I'd have to do is, and it's not that hard. Honestly, if you think about this, if the market is bullish and we believe the market can stay bullish, and this is the one beautiful thing about a bull market, the markets can stay bullish way longer. Now we're coming back to 6. Oh, baby, this is pretty sweet. This trade now, look at this. Larry, here you go, dude. 68.50. It's trading for 590. This trade was a 1770 credit earlier. 1775. now trading for a 555 debit. It's up $1,200. Like if I was in the trade live, I'd freaking close it right now. I'd take the $1,200 winner, and my other risk was 90. So 1220 profit minus 90 minus what was the other one? $500. So I'd make 630 on the day. If I close everything out right now, I'd be up $630 on those 3 flies that I took today. That's a pretty good way to finish the day. And honestly, like, okay, well, maybe I should hold out for another 4 minutes. Well, maybe, but why? It's offering, $1,200 plus dollars. This is almost $1,300 of profit. Take the profit. I know it's in the final few minutes. Take the profit. So 1775 minus 475. I make $1,300. I'm risking 500 on one and 90 on the other. I'll walk away with $700 today. Not too bad. Yep. So I'm showing a 4. Well, I was 25 wide on mine. So 1775, 25 wide. It's now showing 465. Pretty good, man. And there's still 4 minutes to go. It's like that would be a nice trade to close out and not worry about the last few minutes. Yep. So again, I'm not doing it to say shoulda, coulda, woulda. I'm saying it like I take the trade and manage some profit. I'm always curious, like, how did I come to the conclusion that we'd stay sticky around 68.50 today? I have my software. I have my reasons. So I cast a net where if price was in this area, I would have made some good profit. I cast another net where if price was in this area, I have some big profit. And then up here, I had a little weak spot between 75 and 80. But if we were in the middle or the middle or the middle, that is max profit on that trade. So 50 is the middle of this trade. We're trading at 48, 47.9. It's like, so I'm slipping through a little bit. You can see these last few minutes. It's like, it's going to sacrifice some profit there. But this is the magic of the butterfly spreads in the final minutes. Like this stuff pays the peak profit. It's like, it's coming into that final profit trap. So yeah, big difference. Like, yeah, I took the trade in with that. It was 25 wide. And that's why I also had like way more risk in the trade. So we're at 46. Right now it's up to $5. So that's up, 12 and change, $1,200. 2 more minutes for this thing to settle. But if I was in the trade, I'd be closing it out. Like, give me a $5 debit, give me a $4.90 debit, give me a $4.80 debit, take $1,200, $1,300 of profit, close out for $600 or $700 on the day. Not bad. Not bad at all. Now I still made, $200 on the day versus 600 or 700. So, there's a big difference there, obviously, but a good trade's a good trade. A winning day is a winning day. And, you're always learning. You always learn from a win. You always learn from a loss. The most important thing I would say for any trade is manage your risk, manage your profit. Every trade matters. I don't take trades just to throw them away. So, all right, let's see where this thing cash settles. Now it's up to $5, 5 and change. We have 2 minutes left. Let's go back to this option strat. We'll come back to this in a moment. So can everyone see the difference between a long call versus a bull put spread and a bull call spread? So we already discussed like the written form of it. Now we look at it visually, and what do we need for profit? Well, if price were to rip aggressively higher, you can see that we've got a lot of time left in the trade, right? A lot of times in the trade, if price goes up, we get some partial profits. All that's good. I can get near max profit if price is way, 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 way higher. But if we wait for expiration, there's expiration. That's where you need to know the break evens. As long as price is, if this is a credit spread, as long as price is greater than 683, I keep all of that credit. Yep, it's dropping. Fine. Good. I'm out of the trade. 68.43, it's still offering about 575 debit. So that's still, 1775 minus 690. It's like it's dropping fast. So we're slipping some profit here. Cash settled around 42. Let's see, the bell just rang. So let's see where this thing settles in about a minute. 44 is not bad. 43 is okay. 40, if it sneak up to like 44, 45, that'd be a little bit better. Let's see where this thing cash settles. Oh boy, 41. That's a big drop. So again, like when I talked about it live when it's at 68.50, that would have been the best trade. Close this thing out at 3:56 p.m. and grab a, $5 debit. So 1775 minus the $5 debit, I make 1275. The other trade was risking 500. The other trade was risking $90. You make 685 on the day. That was managed within the final 4 minutes of trading. It cash settled at 68.40. So I go 1775 minus 975. Nope, 1775 minus 975. Damn it. 1775 minus 975. There. I make $800. I'm risking 5 and I'm risking 90 on the other two trades. I still make 210. Well, I made $200 today. So if I didn't manage the trade, I pretty much walked away with what I had anyway. But crazy how literally the 3 or 4 minutes made all the difference in the world between a $600 to $700 day versus a $200 day. Yep. Larry says, or a 750 loss versus a 500 win. Big difference. Okay. Bashy, what he's saying there, but the call is like buy in a put like a that doesn't make any sense to me. Is call like a buy and put like a short? No. No, so it's like this. When you hear call option, generally you think of a call option equals a bullish bias, okay? But there's an exception to that. And a put option is generally a bearish bias. Okay? That's if you're doing a long put equals a bearish trade. Okay? And this is the stupid stuff that's like options can be so confusing. This is what I hate because it doesn't have to be confusing. I don't want it to be confusing. A long call is a bullish trade. Okay? But if I do a buy call and a sell call, so that's the example we did today, the 683 buy call and a 684 sell call. Okay, this is a bullish debit spread. All I need price to do is be above 684 and I make money. Okay, I can still express this with a bullish trade, but then I sell a put and I buy a put, but as long as I sell the higher strike. So I do a 683 sell put and a 682 buy put. This is still a bullish trade. This is a credit spread. So that's where it's confusing. If you just think always calls is bullish, not necessarily. Just it's understanding that nuance between, if we're doing a debit spread or credit spread, there's a different way to express that. Okay, if I did it here for the put option, if I buy a put and sell a put, so we buy the 683 buy put and sell the 682, that is a bearish debit spread. And if I sell a call and buy a put, sell a call, and I do the 683 sell call, 684 buy call, this is a bearish credit spread. So here's the easy way to think about it. If you buy a call, okay, if I buy a call, I need price to go up, okay? If I sell a put, if I buy a call, I need price to go up. If I sell a put, if this is a sell put level, I need price to stay above this strike. As long as price is at or higher, I can collect the premium from selling that put. This is Warren Buffett 101. Here's the asset price. Warren Buffett says, I'm going to sell a put 10% lower. If price never touches that put, you're going to keep the premium on that sell put. Okay. If I buy a call, I buy it, I pay a debit, I need to cover the cost of that trade, and price goes higher. If I sell a put, my credit is maximum. My risk is all the way to the downside as if the stock could go to zero. But the idea is you're selling a put, expressing to the broker, I'm willing to own shares at that price. So it's a little bit of nuance. That's why I don't try to define it like calls are bullish, because they're not, right? Depending on how you use that call, you can trade it for a line in the sand. So if I sell a call, I don't want price to go above that. I want price to stay below this call if I sell it. If I buy a put, I want price to go down because I'm trying to trade that thing bearish. So when you sell, okay, if you sell a put, it's a line in the sand. Think about it that way. If I sell a put, if price is above it, I keep all my credit. If price is below it, I get assigned the stock. And hopefully, if you're doing that trade, it's because you want the stock and you want to get it at a discount. Okay. If I sell a call, I sell a call. I don't want price to go above the strike. I want it to stay below for me to collect all the premium on selling that call. If it goes above this, the broker could assign me negative. The broker could assign me that I'm selling the trade. So the only time I like to sell calls is if it's defined risk or I'm selling calls based on what I already own, which is a covered call. Yep. So close, but like I said, I mean, it's just understanding that if you're expressing a debit spread or credit spread, there's just a slight difference. But that's the review stuff. You know, you get a couple examples. You do a lot of examples. I walk you through this in the videos for practical options. I'm trying to think practical options here. So, going through the strategy guide, I give a lot of examples where it's like price is here, you do this trade, here's what it means. This asset, you do this trade, this is what it means. And you just kind of get the hang of like, okay, this trade with my break even, where do I make money? Where do I risk money? If you can understand that, then you're playing chess, which is good. Okay. All right. So cash settled today at 68.40.20. Net, pretty happy on the day. If we want to take daily profit all the way to zero, it was a full profit today. I made it was 2 contracts, one for 50 cents, one for 80 cents. Pretty happy with that. Overall P&L is positive. That's good. I did videos, like I said earlier in the session today. I did videos for my pinch point scanner. I did a full video review right there of all of our positions. I also did one for Project Options Edge. So if you're in those services, a full video review on the positions that we have. And then this session, as I wrap things up here in just a couple of minutes, I will take this video, download it, and I will post it inside my Telegram right here. I'll just add it to this link. So if you're in my Telegram, I'll add this and say like Practical Options, October 31st, video review. Check it out. You can have it, play it whenever you want to. I'll also, this will be archived in my YouTube channel, and I'll just change the thumbnail and make it a strategy 101 session. Check it out at your leisure. Okay. I need the course. That's the full course. I mean, it's up to you, man. I mean, the 27 is a great way to get started. If you're thinking like, I like the option stuff, I want to learn more, the full course is a little bit more robust. The full course is 13 different strategies, and it's a 72-page strategy guide, and plus heat terms, plus the risk graph, plus the options chain. So just, like here's what I did. I started out this build out. I built out practical options with the full course first. I built the full course first. Why? Because that's what I want to do to teach anybody. I'll teach you everything I can in options to give you some of my favorite strategies, up, down, sideways, and make it hopefully a lot simpler to apply and a lot easier to understand versus just reading a textbook, going on Investopedia, and seeing all the confusing terms that everybody throws out there to sound smart. So I built the full course first. Then I thought, okay, I get it. Maybe not everyone is diehard about options like I became the last decade plus. So let's build something a little bit more digestible that is just like, look, you want to be bullish or bearish in the market? There's a pretty easy way to do it, and it's also really cost effective. We essentially walk through a live session of the quick guide today. And if you want to review that, there you go. So you can hit me up anytime. It's in my Discord as well. Those full links are available, or you can send me an email. Okay. Chuck, I see you now coming in here. Debit spread and then CL. I don't have a CL debit spread. I have a CL credit spread. I did a put condor like I do in Waterfall Strategy 2 for CL. Here it is. Here is CL right here. I got 22 cents credit. I'm up $155. The max profit is 220. So as long as CL stays above $50 by December 16th, I will make $220 on this trade. I also have a $500 profit trap if price somehow comes into the 51 to 50 area. So let me see if I can show you this trade. Can I analyze this? Let's go back here. There's a good example. So this is the actual trade inside the broker platform. Here's the live price of oil futures. Okay. So as long as price stays greater than 50, so CL for the December 16th, if we stay above $50, this is a $2.20 credit. So price can go nowhere, price can go up, price can even come down. I can still make $2.20, which is 220 bucks. If price is between 51.50 and $50, so that $1.50 profit trap, this offers me a $500 profit trap in addition to the 220. So I could make potentially 720 bucks on the trade, but that's got to be pretty perfect. So that's the only CL trade that I have, Chuck. So I'm not sure if that's what you're referring to, but it's a 4-part trade because I've got a debit spread and a credit spread. But that's the only CL trade that I have. Okay. All righty. Hey, man, happy Halloween. Have a great weekend, everybody. Let's come back and do this again. I'm happy to field some questions. If you are interested in contacting me, anybody that's a member of my services, Daily Profit Play, Waterfall Income, Newsbreakers, Double Ups, Pinch Point, Crash Insurance, Project Options Edge, you get my practical options. If you need to reach out to me at any time, this is probably the quickest way to get me, chrispulverpub@gmail.com. If you have any questions on my courses, services, alerts, packages, things like that, support@presspartypub.com. Okay. Where am I at every single day? I'm usually here on YouTube several times a week. I'm running a daily profit plan session Monday through Friday at 9 a.m. Eastern time. I'm here to trade with you. My Telegram is up to 2,100 followers. My YouTube's creeping up to 10,000 followers. Who's ever watching, I hope it helps. That's why I'm doing it. All right. So what you can do at the end of this, like right now, is everyone that's watching this live or everyone that watches this session after the fact, please on the YouTube channel, click the thumbs up button. I know it's so silly and it's so easy to do, but it does make all the difference in the world. If I want to see some organic growth on my YouTube channel, I'm not going to pay for bots. All that stuff is like basically it's all frowned upon in YouTube, and they will ruin your channel for it. So, I've gone from 0 followers to nearly 10,000 in a couple of years, and it's all organic. I don't buy ads. I don't do sponsored anything. It's like I just put organic trust content out there. If it helps, great. But in order for this to be seen by more, I think it's pretty easy to see that there's a bunch of charlatans out there that will fake, profits, and they don't trade live and they have no idea what they're doing. And they've been doing it for maybe 6 months. Maybe they started trading in 2024, right? Maybe they started trading since COVID. Well, if you bought anything during 2020, you freaking made triple digit gains. Everyone looks like a genius. But what I'm prepared for is if things get really dicey, I'm not going anywhere. I've got to trade through this crap and navigate these wild and crazy markets and try to do a good job. That's my job. So if that helps, I'll still be here in 5 years. I'll still be here in 10 years. And hopefully you're figuring out how to navigate the markets. Cool. All right. So that little thumbs up button helps, goes a long way. And if you subscribe to the channel, notification bell, we're live, you'll see it, and support it. So one day, maybe I'll just be, members exclusive, and I'll, have a private, but I don't care. YouTube's great. I think it's great for short form, medium form, long form education. I've probably learned more stuff on YouTube in the last decade with things I want to learn. And I think, financial education is great where you look how to find it. I've got a lot of content. I listen to podcasts, I read a ton, but it's never mainstream media news. It's always data, FactSet, Koifin, macro stuff with Bloomberg, some newsletters that are, crazy bullish people, crazy bearish people, somewhere in between. I don't like the extremists. There's extreme bulls and there's extreme bears. They're nice to know, but I'm kind of looking to form my own opinion, but I'm just trying to stay well informed, and it's a lot of content. So good stuff. Anyway, hope that helps. Good session today. Hope you had a lot of fun. I did. And if anyone's interested in getting started, I think Practical Options is it's a course that I built for anybody that's trying to learn. It shouldn't take years to learn something about options. In fact, here's what's crazy. If you learn how to trade options, if you learn how to trade futures, that is literally where the world is. Like everybody's trading options and futures because it's active. It's actually leveraged. But learning how to trade them I mean, I trade futures a lot, but I trade futures options. Why? Because it's defined risk. you know, um, you can take such good trades. Always control your risk. Never get emotional about the ebbs and flows of your wins and losses, and just keep taking good trades. You know, I've said this for years. It's been one of my, kind of coin phrases, but process equals profits. And it's very true because if you stick to a good process, you trade something that's inherently bullish with a house edge of 55%, and you exploit that in a time of a bull market that can last years and years and years, there's a lot of money to be made, right? Um, if you think the market's going to implode and go to zero, okay, I hope you're a bear for the very short time that it happens. But the most money is made when you're scooping up liquidity at the bottom, and that bottom might be 10%. That bottom might be 30 to 50%. That bottom might be, heaven forbid, a 70% pullback. Like 2000, 2001, this big bubble everyone's talking about, maybe we have a 50% correction, right? But I will say that if we have a 50% correction, I want to be ready to invest and surviving all the way down so I have the dry powder to buy what is going to essentially double when it gets back to those highs again. It'll take time, and this whole stuff you read about with fourth turning, all the chaos and all the uncertainty, it's all going to happen at some point. Nobody knows when, you know. So I just say there's extremes, highs and lows, bulls and bears, and then there's the truth, and somewhere it's in the middle. You got to find it. Okay. Can we look at currency? I'll do this. Spot check currencies. It's Friday. The market's going to close here in about 45 minutes. Currencies. Did anything exciting happen today? Not really. 30 on the upside, 35 on the downside. You have dollar and yen, on top today. You got pound that made a little comeback. Aussie, CAD, Swiss is weaker. I don't mind seeing a weaker Swiss, that's for sure. Gold and silver. Gold. Let's go to the daily. I'd like to see gold, maybe pull back a little bit deeper. That'd be great. I'm trying to buy some more gold at discounts. Silver, same thing. If it's high, low, low, I mean, I could see this high, low, lower, high, lower, low. Maybe we come back up here. Maybe there's a little more pullback, but I'm scooping up some silver. I mean, look, I've been in silver for over 3 years, and I finally enjoyed this run to say I'm taking some profit. So now I'm ready to get back into it, but small, and I'm taking bites. I'm not going heavy. I'm going to nibble, 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 build my position back up, and then express a core position again. But I took a lot of profit in a 2 to 3 year run, so I'm ready to start again. Oil, Bitcoin, 109. Bitcoin could pull all the way back to like 90K. I'm still pretty bullish on it. It's not going to be fun to see it happen. Or if we just accumulate more. I thought Bitcoin maybe after this October rate cut would show a little bit more promise, but the market might need a little bit more of a flush to the downside. Once the market kind of catches some traction to all-time highs, we might see Bitcoin rallying on top of that. So keep an eye out for a little catch-up trade in Bitcoin. That might happen. Let's see your copper. Copper is crazy. What a wild year this has been on copper. I was long copper into this like 2024, 2025 pullback. This crazy disruptive move, like it distorted all prices in copper futures, so I stayed out of it. Although I did want to take the bottom, it was just bad. It was bad reward and risk. Japanese yen, along the Nikkei, all-time highs in the Nikkei. EWJ, somehow this baffles me, and I don't know if this is because the bottom 15% are finally starting to perform better in the Nikkei, but this EWJ is supposed to be ignoring the bottom 15% of the Nikkei, and somehow this is not going higher, but the Nikkei itself is. So either we have like a bunch of garbage stocks in the Nikkei that are underperforming that are finally catching up, or I'm just getting a rip-off price here on EWJ. DAX, not at highs. FTSE, at highs. I was wrong about the FTSE. I was thinking, when this first started to break out, I thought the DAX was a better instrument. Once we had this rally on the DAX and a big pullback, I thought the DAX was going to be better positioned. FTSE is actually acting and behaving way better. Much more of an aggressive trend. But the sacrifice on the FTSE is that the pound has been weaker. Bunch of other ones. Brazil, I'm long Brazil. I'm looking for pretty decent highs to get pushed. If we get a love for commodities, I think Brazil gets to the 30s, $35, $40 zone. I'm long EWZ. I'm long ILF. There's maybe a range trade here, but if we start breaking higher, this thing into the mid 30s and 40s is also a pretty profitable trade. Mags, you know them, you love them. They're driving the market. We've had some noise this week, but we're still hanging in there. If Mags clings to these highs, the S&P is going to be resilient. Apple, I mean, all your Mags. So we'll see. Mags is so concentrated; it's a huge part of market cap. Earnings for the most part, Apple beat, Amazon beat, Broadcom. I think they have earnings coming in October. Nope, December. So this was July. This is December. Wow, so it's way out there. Google smashed earnings. Meta missed. I'm going to see if I get filled on that 610, 615. Microsoft beat earnings, but it faded off the recent highs. Netflix, I was trying to buy a 1075 that didn't fill. Nvidia, I took profit on pinch point. We had a nice little run. I took like a 15 to 20% winner there. Tesla, I think Tesla still has legs to get up to like 500 plus. I'm hoping it does. If we pull back to 360, I'm still buying it. Berkshire, Buffett's retiring at some point. Berkshire is getting crushed. It's also underperforming because it's not tech exposed. But at some point, they'll have lots of cash. They'll perform well. We'll see. There's a time and a place to buy some Berkshire. 10-year yield. I do put this out as a red flag. Okay. If we see that the Fed has just cut 50 basis points, this thing hasn't moved. So the long end of the curve is not going lower. I don't love that. It's not as bad as an adverse reaction that we saw back in September 2024, but it's still a concern that yields are not going lower. So in order to buy a house, in order to buy a car, in order to refinance anything business-wise, you want to see lower borrowing rates. And it doesn't make any sense for people to have to take out 12-month loans in order to get a better interest rate. But that's essentially what our government is doing, as we're financing everything within like a 2-year window instead of 10, 20, 30. So we'll see. But this does make me nervous, at least moving forward in the near term. I get it. Like we may not blow the top off, but we're going to see like sticky rates, and bond yields are going to be higher and bonds are in question. So we'll talk about that more. Average mortgage rate 6.17. That's gone up. We were like low sixes. Now it's 617. Currency wise, not much happening. That's currency strength. Very boring day. Watch the dollar, right? Watch the Japanese yen. Morning session when you're doing the butterfly, is it possible to take several trades? It is, Chuck. It totally is. That's a double up. I mean, that's a double up 101 type trade. It's possible, but you're talking about levels. If you want to risk 30 to 60 bucks, you're talking about taking like 5 wide spreads. So you got to be pretty accurate with where you put those things to take those small of a debit. If you do it on the SPY, you can take like, 10, 20, 30 cent debits all day, but you're only going to make a couple $100. SPX, you can go 5 wide. You can get up to $500, but you're going to pay that 30, 40 cents, but you got to be really accurate within that final 5-point move. So anyway, we'll talk about that more next week. Bring a question up next week. Are you in double ups? Are you in my daily profit play? I'll happily do a segment on it. We can do like a, anatomy of trade. I'll dissect it in class. Jerome Powell wasn't so rate cut happy in the FOMC. No, it's not that. It's like, it's just that global PMIs are rising, global yields are rising, and the US and the Fed, like, look, the Fed has never controlled the long end of the curve, ever. And so right now, it's like everyone is parked into equities and everyone is questioning the solvency of the US at some point. It's like we have $38 trillion in debt. We were like lightly downgraded this last week or two. And, if debt keeps growing, we have like basically irresponsible fiscal policy. So if the Fed is cutting on top of that, I mean, the Fed has never controlled the long end of the curve. But what's odd is it's broken the correlation where usually when they cut, things follow suit. So I don't know if we're going to be lower in rates. I hope that we are, for the sake that everyone that wants to buy a house can see rates come down. But I think the scary part is rates don't come down, but maybe house prices do. And that's going to depend on new homes versus existing homes. But everyone's talking about a housing crisis. Put it in perspective, because about 70% of all American homes under mortgage are sitting like sub 4%. Because of what happened during COVID, everyone that refied, we have like 70% of every fixed mortgage is under 4%. So what it's doing is forcing people to sit and stay in their house, but they're sitting at an interest rate that is unreachable right now. So I don't see a housing crisis. I see that there could be a supply glut where we have so much supply to catch up, and eventually nobody buys a house because it's just too expensive. Prices are too high, rates are too high, nobody can buy a house. But those that have a home right now just stay in it. So time will tell. So yeah, anyway, the Fed doesn't control the long end of the curve. They control the short end. So what we are doing right now is essentially financing our debt through 3-month, 6-month, 12-month, 24-month treasuries, which is insane. But Janet Yellen started it. Powell's continued it. And Besson even supports it. So I don't know if we're just doing it as like a short-term solution until things get a little bit more stable on the long end, but it's still not pleasant. Like it's just like, what are we doing? $38 trillion financed in 1 or 2 years? That's crazy, man. Can you imagine going to the bank every 1 or 2 years to refi? And it's like, and it's pretty sketchy how the Fed is somehow, refinancing at like 3.3% when that rate is literally available nowhere. Nowhere can you finance anything for 3.3% right now. And yet that's the Fed's financing rate. So we'll see. Okay. Yep. And there's a lot of people that argue on the 2 year. That's probably the best thing to watch. Whatever the 2 year is doing, if you go US O2Y, whatever the 2 year is doing is going to kind of dictate whether or not, bond yields are cooperating. If you want to see the bond market, if you want to see bonds go down and the 2 years going up, that's usually a correlation. A lot of people like the 2 year as a better guide versus the 10. I look at the 10 because it's where I'm seeing like house prices, car prices, you know, any type of refi, it's going to be in that longer term window. But a lot of the stuff that's happening now is like this is your impression of what the bond market's really pricing in. If 2 year is ripping higher in yields, you're going to see a lot of trouble in the bond market. But if it just, I don't know, just stays choppy, like nothing really gets disrupted here. We just don't want to see these aggressive rates of change. That's the hard part about the bond market. When you have these crazy volatility events, that's when things get really nasty. So if it's calm, cool, a little bit lower, a little bit higher, nobody really pays attention. But it's the big rates of change that are aggressive you got to watch. Okay. All right. I'll let you go. Have a great weekend. Come back and join me on Monday. See you. Bye.